Hey everybody, Matt Plant here, another video for you. Today I'm going to go over, because we're at the very beginning of 2024, I want to go over really the 5 things that I think are going to impact the stock market and economy in 2024. And so there's, I think by and large this year will probably be a fairly standard year, especially for an election year. Election years you tend to have some volatility, but at the end you end up right around the general average for the stock market, so 8 to 10%. So I think there's probably a pretty good chance we end there. Now the question is, how do we get there, and do we end up higher or lower than that? And I would say these 5 things I'm going to go over as we go throughout the year, as we see those things getting better or worse, will probably determine which direction it goes. So for starters, we're going to start off with unemployment. So number one, if we start seeing unemployment, so a lot of layoffs, a lot of unemployment rates going up, so more and more people are without work, that's a bad sign. It's not a big deal if we have just a little bit, we have some layoffs. That's terrible for the people that got laid off, but from the economy and the stock market standpoint, little bits of layoffs aren't necessarily a terrible thing. That just means the companies they have too many employees for what they need to do, which means the company will probably be more profitable if they can right-size their business and have less employees for their needs. So if employment starts really pushing up, we see in the 4 to 5% range, we really want to keep an eye on that. That could mean that market starts to go south. But if things start leveling off and it's just little bits of layoffs here and there, market will probably like that. Number two is the consumer. How is the consumer doing? And how much is the consumer struggling? Because right now the stock market thinks consumer might be a little on the edge coming here soon. And so the way that we can see that, the one thing I would say you really want to keep an eye on is the debt of the consumer. So if you see, if we hear about credit card balances getting too high, or automobiles being repossessed, so really things that means we as the consumer can't afford what we've taken loans out against or have purchased in the past, we start seeing issues there. That means the market starts to tail off. Now, if we don't get any of that, let's say the debt rate comes down, people have less and less debt, stock market's probably going to like that, and we'll get above that, probably above that 7 to 10%. Next up, number three, interest rates. Interest rates are a big deal. Been talking about those for the past few years. We've seen them really go up over the past, let's call it year and a half. Really move anybody who's taken out any kind of loan, whether it's a mortgage or an auto loan, they can probably tell you it's significantly higher than what it was just a year or two ago. So if we see interest rates start to go up, the market is not going to like that. It also isn't going to like if we see interest rates go down really quickly. Reason being, if interest rates go down really quickly, that generally means, when I say really quickly, that means if you see over the course of, let's say, a month, 2 months, 3 months, interest rates go down by 1-2% kind of thing, that means the Federal Reserve is trying to push money into the economy because the economy is really struggling. So we don't want to see that. Now, what the market would probably really like is if interest rates stay about the same as where they're at now, or they go down just a little bit. Because they go down just a little bit or stay where they're at, the market can handle that. It'll see that as a positive sign. And it'll probably, again, that would end us above that 7 to 10% range. Number four, I've been talking about this. You're probably tired of hearing me talk about this at this point. Inflation. Inflation has been a big deal. It has come down dramatically, though. Come down significantly, back down to the normal 3% range. We're not quite there yet. We're right around the 4% range. We're coming down, and so if the market sees inflation start to turn back up and start going back up into that 4.5-5% range, market is not going to like that, and we're probably going to end up being below that 8 to 10%. Now, if inflation keeps coming down and keeps going down towards a target of 3%, that the market is going to like. So that would be very good. And I would say one of the things you can, just as a barometer to see whether or not what inflation is doing, the easiest way for the average person is just to look at what's going on with the gas prices. If you see, when you're driving around, you see oil or gas prices jumping up relatively quickly, so it goes from, let's say, $2.50 to $3.50, or 3 to 4 kind of thing. If it really moves up relatively quickly, that's probably not a good sign. That probably means we may have some inflation down the road. So you want to keep an eye on that. Again, gas prices is probably an easy one to kind of keep an eye on to know if they go up a bunch, stock market's probably not going to like that, and we could see it ending below that. Now, the last thing, number five, this is, I would say this is less of a risk and more of an opportunity, in that every year when it comes election time, people kind of get a little crazy and do strange things with their investments because this person's going to get elected or not get elected or something to that degree. And generally speaking, when that happens, if people start selling their portfolios or selling things off because, like I said, someone's getting elected or not getting elected, that's usually an opportunity to step in and buy some things at a much discounted rate. So let's keep an eye on that, because typically during an election year, there's promises that are made, there's things that are said, and people, like I said, they start doing things that aren't really in their best interest, and they just start selling things randomly. So let's keep an eye on that. Those 5 things are probably going to drive the stock market this year. And again, I think at the end of this year, we'll probably end right around that average of 8 to 10. But I do see some possibility that we end above that. We end in that 10 to 15% range for the stock market. I can see it happening if some of these things start to look a little bit better. It doesn't take a lot, just a little bit better on some of these 5 things, and we could be in a really good position. So thanks. I'll see you guys next time.